This is the Aftermarket Radio Network.
Welcome to another episode of Business by the Numbers. I'm your host, Hunt Emerist, CPA with Parmelis & Associates. So back-to-back weeks, just getting back from another conference, and this time it was the STX conference down in Nashville. Awesome event. That Gaylord, it's Grand Ole Opry Gaylord Hotel on one. I think I probably wasted half of my time getting lost there. But yeah, of course, special thanks to Charlie and the rest of the World Pack team for having us down there. Awesome time. Great to see a lot of you guys as well. Hope you learned something from my class. I hope you learned something from all those classes. And yeah, for any of those never checked it out, check it out. I mean, it's awesome. It's a massive, massive show. They do a really good job. And like I said, it's always good to catch up with clients and catch up with other coaches and speakers there as well. I was just kind of talking to Carmen Tracy before I started recording on this. Wanted to do something a little bit different this week. And then while I was down in Nashville, while you guys were listening to me speak or someone else's speak, we got some pretty crappy economic news here, but they always drop these on the Wednesdays. I released on Thursday. Hopefully for Carmen Tracy, I recorded before Wednesday. So this one kind of fell right in no man's land. So we're going to talk about that this week. What were those numbers? What do they mean? And maybe what does that tell us about the rest of the year, interest rates, and all that? Before we get into that, I just wanted to stop and say thank you to you and the rest of the dedicated listeners. Just a reminder, if you want to hear your question answered, shoot me an email, podcast@parmelis.com, give you your answer. And if it's a good question, we will talk about it on here. There's no such thing as a bad question. I shouldn't have said that. Don't be nervous. Any question is a good question. Whether I will do a whole episode, I've already done an episode on it or not, I promise you I will always answer your questions when you email it to me. So don't be nervous. Shoot it over. And don't be bashful. You guys have had awesome questions. I mean, the last couple that I've had have made it into an episode, and most of those, even a whole episode of their own. So yeah, if you guys want to hear it, I want to talk about it. Because regardless of what some people think, I do not like to hear myself talk and love to hear that you guys say, hey, it was helpful. I've always wondered that. I used it. That's exactly why I do this. And lastly, I cannot forget about our dedicated sponsors, NapaTrax and Promotive, for being loyal supporters of the show. Thank you, thank you, thank you. Without NapaTrax, without Promotive, there would not be this show. If you need a new shop management software, if you need some new Rockstar team for your shop, give them a call and let them know that we sent you. Hey, did you know NapaTrax is on-site training plus 6 days a week support? It all starts when a local representative meets with you to learn about your business and how you run it. After all, it's your shop, so it's your choice. Let us prove to you that Trax is the single best shop management system in the business. Visit them online at napatrax.com. That's NAPATRACS.com. If you're looking for a full-service staffing solution that does everything from sourcing, qualifying, creating job descriptions, scheduling interviews, to negotiating job offers, Promotive is your answer. Visit them online at gopromotive.com. Before we get into those numbers, I need to do a quick update on last week's episode. So last week's episode was about wealth tax, my thoughts on it, if I think it's going to happen, and wow. A lot of you guys are really concerned about wealth tax, and I love to see it. I mean, obviously, you have to be making some money if you think that you're in the crossfires for wealth tax, and we're not going to get into all of it again. I spent way too long last week talking about it, or hey, maybe it was the right amount of time. But yeah, we went through it in depth, what it's going to look like, why I don't think it's going to happen on it, et cetera, et cetera. Like I said, this week they dropped a couple things on us, but one of the biggest things that it might have been out before this, but I actually got some time to look at it, was the proposed budget for this upcoming year. And this is Democratic proposal. This was, Joe Biden's proposed budget for 2024. And like we talked about, the big thing here is even the Democrats know that the Republicans are not going to probably be okay for another budget that increases the deficit or keeps on increasing it at an increasing rate. There is no possible way that Republicans or Democrat could ever put together a balanced budget this quickly, but they're trying to balance it more. Now, as we talked about in the past, this is not my political feelings. If you read between the lines, you can probably figure out which one I feel more strongly on. Hey, I'm an accountant. Don't forget that. But really this balancing a budget is something that both sides claim that they're on board with. In reality, neither of them are on board with. But generally, the historical way that's always been done, Democrats do not like to decrease spending. They like to increase revenues. How does the government generate revenues? Really one metric and one metric alone, that is taxes. So if you want to increase revenues, you're increasing taxes. Now, on the other hand of things, Republicans do not like to increase revenues or increase taxes historically on this. And generally, the way that they balance a budget is trying to cut out social programs and other government spending. In reality, as we've seen over the last really 25 years was the last time we had a balanced budget. I think it was under the Clinton administration that we had a surplus there a little bit. I mean, we've been fighting some war or battle or invasion for that remaining time after that, which is generally doesn't help the budget either. But yeah, I mean, neither side has been fiscally conservative. We're going through a ton of stuff right now on this. And yeah, I mean, we'll see. Are they going to raise taxes? Is any of this stuff going to get passed? Who knows? I mean, the last thing I want to do is have a episode talking about the election, and we're going to hear all of that enough. Just kind of keep this in mind. Right now, we know that we have kind of lame duck, well, not lame duck, but we have a split Senate, House, White House. There's not a uniform party in all three of those to be able to get anything passed on it. And really, as we've seen on the budget and all this stuff, it's just been absolute gridlock. So depending on who you think is going to win, who you're voting for in the fall, it could stay the same. It could go drastically different. The biggest thing on this is I can't see either of the House, the Senate, obviously the White House only needs to flip one seat to flip from Republican to Democrat and vice versa. But the numbers in the House and the Senate are both very close. And so let's say that the Democrats lose the Senate, Republicans take that over. I mean, there's a chance that it could flip on the opposite of it, and you would have the Democrats controlling the House and, Republicans controlling the Senate. No matter more or less who's in office, depending on which house you control, obviously there's different powers that they can vote on without the authority of each other. But if they want to get something major passed, specifically like tax law changes, you're going to have to control about all of them or a bipartisan enough issue where you can get people to cross the aisle, which just does not happen anymore. And also in a lot of these cases, as we've seen, even at this, when the Democrats controlled all of this, they still couldn't get a lot passed because not everyone votes on a party line. I mean, most people do, but there's a handful of people that kind of swap back and forth that it was always kind of shaky to have the majority here in order to get stuff done. So long story short, what I'm about to tell you should not freak you out, should not scare you. Maybe it will change your decision on how you like to vote, but we'll see what you feel when you hear about this. You can look this stuff up. This is a real story on it. This is a real proposal that they put out there. I'm sure that you can read somewhere what these full tax increases are. And so there's a lot of different things buried in there, probably stuff that I didn't even really read into. I saw it and I was like, ooh, man. I am not sure how this is ever going to get passed. But the whole reason that's coming up is the wealth tax. So the wealth tax was mentioned on there. And to make you guys feel a little bit better, I don't think that this is going to be passed any way, shape, or form. Or if it does, not anywhere close to what they're saying here. But more or less, the wealth tax would be for people that had wealth over $100 million. How you calculate that? Yeah, I don't know. Good luck. It's all back to the unrealized gains and market value and stuff like that. And also a good news is I don't think many people listening to this are probably going to have to worry about that, having that $100 million mark. If you are concerned about that, if you're sitting here, Hunt, thinking, hey, I'm worth $120 million right now, I'm really concerned about the wealth tax, yeah, shoot me an email. I'll give you my bank account number, and you can slip some of that off of there, and that'll be your tax savings. Get you down to $99 million, and you don't need to worry about that wealth tax. And luckily for you, I don't have $80 million. So that $20 million you send me, it's not going to put me in a wealth tax area. But seriously, it's a ton of money on there. And again, I just don't think that this is going to happen. So if they come up with a wealth tax, it's still probably not going to affect any of you. And like I said, if they come up with a wealth tax, they're creating a whole new problem. Not all of these, watchdog groups and stuff like that. I mean, a lot of that is very political as well too, even though they're supposed to be, nonpartisan groups that are doing this one. But the tax groups are sometimes pretty good on it. And one of the things that they talk about is every time the people, do these tax plans or these tax proposals, hey, this is what the increase would be and this is how much extra revenue we would get. It's always kind of funny because one of the constant that they hold is, hey, no one is going to change your behavior over a massive increase in taxes, which is hilarious. People like myself and plenty of accountants out there where our job is to play the cat and mouse game, one step ahead of these rules, these changes, these information. So do you think someone that's worth $300 million is just going to lay down and be like, all right, go for it, government, chop off a good portion of what I've earned over my life? No, not a chance in you know what. What you would see is a lot of people just leaving this country. We've seen this in Europe a good bit on it. America makes that a little bit trickier, harder for taxes. But if you're worth $300 million, you'll probably figure out how to rescind your citizenship and get out of that wealth tax. Transferring it before that, and even trying to do some different stuff with inheritance, whether or not it was actually outside the family. So yeah, crazy, crazy, crazy stuff here. Now, the one thing that was in there, and it was a massive change, and this would affect some people, still not a lot of people, but it will affect some, was the increase in capital gains rate. Remember, capital gains is taxed at a different rate than how you make money. Let's say that you make $1 million a year on payroll. Then their highest tax rate is almost 40%. If you were to make $1 million and it was on capital gains, which is selling something that you've held for more than a year, is considered a long-term capital gain, those tax rates max out at 20%. Generally, capital gains, or almost all capital gains, are more or less passive income. They're incentivizing people to hold. And that's why there's a difference between a short-term capital rate, if you buy something and sell something in less than a year, and a long-term capital gain after a year. The whole idea here is stimulate the economy, have people hold on to this stuff for longer to get their more favorable tax treatment. And yeah, obviously, for whatever company, business, municipality they're investing in, the longer-term assets are better for them as well because they can actually do what they need to do and don't have cash crunch or cash pools situations. What the proposal is, it would move the top capital gains rate to 46%, thereabouts, which is, over 100% increase on this. Obviously, as you can see, well, Hunt, what the hell? The top capital gains rate is going to be higher than the income tax rate? No, they're going to raise the ordinary income tax rate up that high as well, too. Now, obviously, neither of those are good. I mean, neither of those taxes are moving the direction that I like to see them. And also, like we learned about last week on this, if my capital gains rate is 46%, and I live in New York City, I'm going to be paying an effective tax rate of 60%. 60% of my money is going to go to Uncle Sam, to the state of New York, and then for, New York's example, the city of New York as well. Craziness. Crazy, crazy, crazy. I mean, I just don't know how someone can look at this and be like, yeah, I think that seems right. That seems like people are paying their fair share at this point. Like we talked about last week. Why someone, if let's say you make $3 million, now you make $4 million, essentially what it would be is, well, now you make $3 million and now you make $3,400,000 because that extra $1 million that you made, $600,000, that's going to go to the government. But they let you keep $400,000. For some reason, a lot of people argue taxation is theft, and I'm not going to argue the other side of it. But when you look at it that way, it's really, really kind of slaps you in the face, especially when you're looking at stuff like capital gains. Hey, I'm investing, I'm holding on to this. I did all the risk. If I lose money, the government's not going to pay for it, but if I win, they want a cut of it. Yeah, it doesn't seem too good. Also, the best part on capital gains, if you make $100,000 in capital gains, you're going to pay tax on that. You lose $100,000 in capital gains, they will only let you deduct $3,000. Yeah, tell me that the odds are not stacked against us here. Real quickly on this of where that 60% would put us, 60% tax rate puts us something that we haven't seen till essentially like the 70s. Between World War II and the 70s before Reagan, the tax cuts and stuff like that, yeah, the interest rates were super high. Now, can you compare it to nowadays? Absolutely not. Completely different structure, completely different economy in so many ways, shapes, or form. The only time we've ever seen that drastic of an increase in taxes has always been during a war. Literally, there's only really two other times we've seen taxes get raised that much. World War I, you can probably guess the second one, World War II. Now, a little bit creepy here, but if we see these tax rates again, chicken or the egg type situation, I'm not going to say it, but it's weird. Fun fact for you guys before we move on and talk about some of these economic numbers that came out. Did you know that in 1912 there were no taxes? That is right. 1913, the wonderful 16th Amendment was passed instituting a federal income tax. Now, 1913, as you guys can imagine, right before World War I. And so in 1960, they actually raised it even more to fund the war. Kind of made sense. I mean, taxes kind of go back to feudal times. The whole idea is the rich should pay to be able to protect the kingdom. That's more or less what we're seeing here now. But yeah, kind of jumped the shark on whose kingdom we're protecting or attacking. So is any of this stuff going to happen? I don't think so. But a couple of people have asked about the wealth tax. A couple of people have asked about my thoughts on the new proposed taxes. So there it is. I don't think there's going to be a wealth tax. If there is, probably going to be way more money than you have. If you have over $100 million, more power to you. And thank you for listening. And same like I said, tax rates, yeah, it scared the crap out of me too when I see this proposal on it. I don't think that it's going to be passed anything as intended. Like I said, there's a lot of people that are going to be against that on both sides of the aisle. They couldn't even pass a budget. They just passed last year's budget like a month ago. So let's see if they can get that done. That has massive, massive changes. Let's talk about these numbers. Hunt, what are you talking these numbers? And when I mean numbers, I mean from the Federal Reserve. So we're talking inflation, we're talking GDP, we're talking all of that. Real quick before I get into that, I would be remiss if I didn't use this quote because I thought it was an awesome one. We're talking about the history of capital or history of income tax rates. Wonderful article this person wrote, but they put an awesome quote in here. Everyone says, the only two things that are guaranteed are death and taxes. This guy, Will Rogers, I'll give you credit for it. Don't know who Will is, but clever quote here. The difference between death and taxes is death doesn't get worse every time Congress meets. I thought that was pretty funny, but is it funny because it's true? Anyways, really the biggest thing that came out last week we were talking about is two big things, inflation and then gross domestic product. Inflation, pretty self-explanatory, how much are prices rising at all and at what rate? And then gross domestic product, more or less, it has to do with production and stuff like that. Really what this is the barometer of our economy. GDP is going up, then you think the economy is growing, which it is. Things are going well, and then GDP going down or getting negative, that means the economy or overall country is shrinking in economic size. Just like inflation, you want inflation to go up. You don't want to have deflation. That's not a good thing either. And really, we haven't seen that for a long time, right? Prices generally go in one direction. They go up, sometimes they go flat, then they go up, then they stay flat. Gross domestic product is kind of the same way too. You don't really see it ever go negative. It does go negative sometimes, but hopefully not for very long. And then again, you want it to increase, you want it to go higher, but you don't want to go too much. And like we saw before, what happened? Interest rates got super low, economy took off, people were borrowing free money, investing the crap out of it, leveraged themselves, economy went nuts, demand skyrocketed, supply was super low, and prices went through the roof and have not jumped off the roof yet. I mean, it's still way, way, way up there. And if you remember before, whenever we talked about this, and I haven't given you guys a Federal Reserve episode for a while, so you might have forgotten this, but remember when they come out and they announce these kind of things, they will say, hey, here's what the numbers are, here's what we thought it was. How close they usually have this is this number will come in at 3.2, and the market will go a little bit crazy because they only thought it was going to come in at 3.1 or 3.3. It's very, very close. They missed the mark really bad on most of these numbers, like the most I've ever seen since I've been doing this podcast. Yeah, like I said, they're usually pretty close. If they're like 0.3 points off, that is a big deal. Now, what ended up coming in, there's a couple different rates on here. There's what they call a core rate and a total rate on inflation. Essentially, core takes food and energy out of it because food and energy can be volatile and very seasonal. Generally oil's more expensive in the winter when you're using it to heat, et cetera, et cetera. Let's face it, your shop management system is the single most important tool in your shop, period. You need NapaTrax because it integrates with all the major players, including Napa ProLink, PartsTech, OE RepairLink, Epicor, Tire Connect, Mitchell 1 ProDemand, and more. NapaTrax has leading-edge tools and technology that your shop needs right now. Unlike the other guys, we'll be there after your installation with the best training and support in the business. Your training includes a learning management system that is tailored to each role in your company. Simply put, Trax was designed and built for shop owners just like you. It all starts when a local representative meets with you to learn about your business to help optimize your shop's workflow, efficiency, and profitability. For over 30 years, NapaTrax has made selecting the right shop management system easy by offering the best, most comprehensive SMS in the industry. After all, it's your shop, so it's your choice. Visit us on the web at napatrax.com. That's NAPATRACS.com. Shop owners, are you struggling to find and retain top-tier talent for your automotive shop? Introducing Promotive, on the web at gopromotive.com. With over 40 years of combined industry and recruiting experience, we're the ultimate staffing solution. We go beyond traditional agencies. Our team provides dedicated recruiters and account managers advising on processes, compensation, and benefits. We focus on placing technicians and service advisors with shops that offer the best culture, training, and long-term growth opportunities. Trust our experience to match the right talent to your shop. We carefully select shops that value employee excellence and provide an environment for success. Our dedicated team leads the entire process, leveraging our industry knowledge and expertise. Partner with Promotive and experience their advantage to help you build a high-performing team that drives your shop's growth. Visit gopromotive.com today and let us help find and keep the best talent in the industry. For gross domestic product, there's a couple different measures on that, but there's really only one. Well, we're talking about the Consumer Price Index here. So some of these numbers are kind of mixed together because some of what they were using to forecast here was actually the first 3 months of the year, the entire quarter. Some of it was just on March alone. It's kind of all in the same bucket. I think you'll get the idea here. Core inflation came in at like 2.8%, which you might say, well, is that good? Is that bad? Good and bad. So it's a little bit up of where it was in February. It's, more or less, if you look back to November, it's kind of leveled off. Peak of all this stuff was July of 2022. And as the Fed started raising those rates, we saw this stuff start to come down, but then it started to come down slower and slower and slower. And it seems like the last couple months, things have kind of leveled out. Now, if things level out, then what do you think that means? Are we on the bottom of this? Now, if we're on the bottom of this inflation curve and we see that curve start to tick back up, that means that inflation is going back and prices are rising. If the Fed has not started cutting rates and the inflation starts going up, that is something they do not want to see. For you diesel guys out there, that's like a runaway diesel. Not a whole lot of people would know how to stop that. The air intake on this diesel engine is pretty big for you to just chuck a towel in it or something. So if we start to see that inflation start to go, the Fed has really one major thing to control rates or control inflation, and that's interest rates. We already know we're kind of on the upper limit of what this kind of current economy will handle. They start to crank this up too much to try and fight inflation even more. Like we said before, we've run the risk of losing banks, bank runs, and stuff like that. Like I said, they were blown away by this. The market, the economists did not expect these numbers to come in that high. So it ultimately came in at 2.8. I'm almost positive that the original number was like 2.1. Could have even been below 2. Now, the next one on GP, I know how much they missed that one on. But yeah, like I said, 0.1, 0.2, higher or lower and stuff like that. Every time this thing has surprised us, it's always surprised us in the wrong way. There has not been a single one where they've got it wrong and they've been optimistic and it was actually even better than it was. Every single one, they've been optimistic and it came in even worse than it was before, including this one in March where they really, really missed the mark. I think there's just some people in there just wishful thinking because they were kind of estimating what a number should have been that probably would have allowed a rate cut to happen much sooner than what we're seeing now. And we'll get to that in a second. Inflation, they thought was only going to rise by just over 2%. Now, remember, the Federal Reserve, they want to get the inflation down to around 2%. That's their target. Once it's at 2% and they feel like it's confident 2%, that's where they feel like, hey, we have a soft landing here. We think we can start relaxing rates. Because if it's at 2, you can still afford to have the inflation go up a little bit as GDP lifts and not completely kill the economy or overcook it or anything like that. So they thought it was at 2. It's closer to 3 than 2. That is not good. People are still spending money. People have less money than ever. It's the lowest we've seen in 2 decades. Not a good thing. That's not a good goal that you ever want to hit. Gross domestic product, they thought was going to increase about 2.5%. So what they were expecting is they were thinking prices were going to rise a little over 2%, but doesn't matter because the overall economy is going to increase at about 2.5, which is kind of a pretty good number for both of those. You generally do not want GDP to outpace inflation too much over the long term. That can have some issues as well too. I guess depending on what side of the aisle, not really aisle, this is more economic side of it, you could argue that you might want it slightly, but the actual number came in much lower. So we thought it was going to be about 2.5. The actual gross to GDP increase on this was 1.6%. So that means that the economy and the overall gross domestic product of the United States actually was half the increase that they thought it was going to be. That's crazy. Like I said, 0.1, 0.2 difference. They were off 0.9%, almost a whole percentage point off. So inflation is almost twice as high as how much gross domestic product increases. Now, you might be saying, Hunt, I don't know what any of the hell of this stuff means. I've heard about this. I think I probably should know, but I'm still lost. I wouldn't look at any of these numbers individually on themselves. There's a couple big things I'd pull out of here. Now, first one is just like what I said. How is this estimate so far off? What this kind of tells me is that even these economists, even these people doing this, don't know what to expect. There's been a number of people that have just questioned this overall economy that we've had here for the last 3 to 5 years on it because it's really just doing some strange stuff that we have not seen in the past. Even though these are all completely separate events, over the last 30 to 40 years, certain economic indicators have been very, very good judges about future performance, interest rates, and stuff like that. We aren't seeing as much relationship nowadays as we have in the past. So people really just don't know what's going to happen next. So that's a big thing to take out of it. If you hear someone that says, hey, this is what's going to happen, this is when the recession is going to hit, start listening to someone else. When I talk about this stuff, I have no idea. No one has any idea. We just have to see. On the inflation side of it, like I said, it would concern me that we have no idea what's going to happen on it. I know in my own personal life on this, if you look at these inflation numbers and think that 3% is close to how stuff is inflating, again, I'm not sure what numbers they're using, but maybe it's just not including Maryland. Maybe your state's different on it, but yeah, it does not feel like things are slowing down at all. Now, in the gross domestic product, there is one big thing that we are very, very concerned about here. The kiss of death for an economy is what we call stagflation. Stagflation, if you want to look up, there was what you learned about in college of the historical worst case of stagflation. That's happened a number of times in all different places. Japan, I think it was in the 80s or 90s, they call it the lost decade. They had a history where they had a decade-long path of very tough economic times, and they called it what's called stagflation. And what is stagflation? Stagflation is kind of clever there, but it's a combination of stagnation and inflation. So stagflation means that your economy is either not growing or contracting, which means that you have either negative GDP growth or flat GDP growth. Since GDP growth is almost never going to be flat, it would have to be 0.0, no change up or down. Generally, it can also be expanded to very, very, very small GDP growth or obviously GDP contraction. Are we close to that? Well, we have one of the two. Inflation, perfect. We already have it. It's one of our strong suits. America might be becoming one of the best ones, especially as down in South America, they seem to figure out who had our previous record holder. If anyone wants to look up that, look on what's going on in South America, some of these inflations and what some of these other countries are doing to battle it. And I will tell you, it's a lot more drastic than what we are doing here. And it almost seems to be working for them too. Seriously, look up Argentina and what's going on. The president they elected is kind of a wild card, but everyone's shocked. What he's doing is actually working. So yeah, check that out. Anyways, back to what we were talking about before. We already have the inflation taken care of, the stagflation. Now, luckily for us, we don't have negative GDP. And remember, another thing here, 2 quarters of negative GDP growth is a recession, right? That's a definition of a recession. Now, if you remember back in 2022, first and second quarter were negative, and that's when they actually came out and educated us that actually 2 quarters of negative GDP growth isn't technically a recession. No, seriously, this is the White House released a whole campaign trying to explain to us that we didn't know what we didn't know what a recession was. The dictionary definition has not changed, but we are kind of staring down the barrel of another one. GDP growth was almost 5% in the third quarter of 2024. GDP growth fell down to about 3% in the fourth quarter of 2023. And then this quarter right now, so we got, if you're seeing that bar, it's sliding down. So we went from 5, 3, now we're down to 1.6. What do you think is going to come next? Who knows? This stuff doesn't generally go up and down. Now, the only thing is if we flash back to 2022 where that went down to negative 2%, what was the previous month or previous quarter? It was a 7% increase. The GDP increased 7% in the fourth quarter of 2021. And then the following quarter, it was down 2%. And so this is why you can't guess what's going to happen. If you're looking at these charts, even in 2021, up, crash. It's been more or less steady since then. Quarter 3 of 2023 went up. Quarter 4 was still up, but not as much. And then, like I said, quarter 1 of 24 is still up, but we're getting closer to going negative. If we were to actually have negative GDP growth with inflation like this, yeah, that's going to be stagflation. And if we can do it 2 quarters in a row, we get that special mark of recession. The last thing I want to talk about here is, Hunt, none of this stuff sounds good. Does that mean that we are going to have a recession? Who knows? Again, I don't know what's going to happen. If I knew it was going to happen, I would probably have more than $100 million and be freaking out about that wealth tax. But I don't. Unfortunately for me, but luckily for you guys, because if I knew what was going to happen, I probably wouldn't be doing these podcasts. But I will tell you that Wall Street is nervous. Banks are nervous about this. Economists are nervous. Everyone is nervous because everyone doesn't know what the heck is going on here. You might have heard me talk about this before in the past, but it's called the inverted yield curve. And what is an inverted yield curve? So inverted means upside down, backwards in this case. And what we're talking about here is the relationship between the 10-year Treasury note and the 1-year Treasury note. Generally, the way that it works is a 10-year Treasury note pays a higher interest rate than the 1-year, which means that they expect long-term interest rates to be higher than short-terms. As we've been talking around a lot about this, everyone expects the long-term rates to be lower because interest rates are super high right now. And so when the 10-year actually goes below the 1-year, 1-year goes below the 10-year on it, then it's called inverting the rate curve or the yield curve here. The two that I have on here comment, you can do a 3-month 10-year, you can do a 6-month 10-year, 2-year 10-year. All of these are very similar. Almost all of these curves all flip at the same moment. They flip March of 2022. So as we're listening to this today, we're about 24 months since the rate curve became inverted. Now, why is that important? Since 1978, an inverted yield curve for Treasury bills has been a very, very, very good indicator for recession. An inverted yield curve has predicted the last 7 recessions. Again, past performance does not guarantee future success. Your results may vary. And even there's been a lot of critics that came out and said, hey, yeah, everything else doesn't look very good, but there's still a chance that we don't go in a recession. There's a chance I'm going to win the lottery. There's a chance I'm going to get bit by a shark. Low chances. There's chances for everything. Now, what does this all mean? Does this mean we're destined for a recession? Does this mean that things are going south? No one has any money. Savings rates are at an all-time low on it. People are still spending out of hand. Unemployment is still very low. Wages are still not increasing as fast as inflation is going up. So people are getting poorer and poorer by the day. The amount of people turning in used car, new car financing is skyrocketing on this. People have no money. That is the biggest thing that I took out of all of this, is I don't think anything that I said gives me an overly positive outlook on what the near future looks like. There have been some people that have argued here that there's possibly going to be a rate decrease or rate cut in July. It's really tricky here because, like I've talked about before, a lot of these articles, Forbes, Wall Street Journal, all of these guys are just as guilty of it. Some of these guys are literally writing these articles to put out a PR thing about just why they want the Fed to lower rates. They're not really using any sort of theory, any sort of backing on this, just like, come on, guys, it's been long enough. Like, you did your job. There's one, it was actually pretty funny, where they were complimenting how good of a job the Federal Reserve did and already calling a soft landing. Like, you guys have done it. Stop being so serious. Just start lowering the rates. You guys have already done it. No, you haven't. And really, these numbers that are coming out in March terrified the Fed. January looked okay. February actually was looking pretty decent, was moving in the right direction. If they didn't see any sort of negative stuff, they didn't even need to see good stuff in March. They just couldn't see bad stuff. And those numbers that we got were probably about as bad as they can get. Because really at this point, they're looking at this, and if they're really going to stick to their guns, you guys are nowhere close to your target 2% inflation. Honestly, it seems like your inflation fight has really kind of stopped. And the big thing here is that they're kind of missing the boat on is they think that raising interest rates is really going to stop discretionary spending to a certain degree. They think that everyone is an educated investor and you're going to say, hey, auto loans rates are at 12%. I'm not going to buy that car. But at 6%, I'm going to. When realistically, the U.S. economy and the average United States consumer is, hey man, if you can get my payment under $800 a month, I'm going to buy that car. Whether it's at 5% interest, whether it's at 63% interest, I don't care. Or I shouldn't say I don't care. I don't even know what I'm signing. What does that mean for us? What does that mean for our businesses? I mean, it depends on what side of this you look on. Hey, economy's too good on it. People get rid of their cars. People trade it in. You guys might have forgotten that because COVID was good to us. The economy was pretty good. People had a bunch of money in their pocket and they physically could not really buy a new car or used car. That is what you guys are always fighting against, is the old trade-ins. Now, when things get really bad, like, some of you guys may have noticed lately that people don't have much money or they're being a lot tighter on credit. Yeah, it could be hard to get a sale done. Maybe you're not going to be able to do as much preventative maintenance, but I also probably guess they're not going to go out and sign up for $800-900 a month car payment either. This stuff is out of our control. Is it anything that's going to make me to change my decisions? Probably, depending on what they are. It's risk versus reward. You got to make sure that you don't ruin your entire investment for some risky investments. But is anything that I'm talking about here enough to make me do something or not? Personally, for me, yeah, it probably is, right? I'm going to be a little bit more cautious. I'm probably going to hang on to my money a little bit more. If a good opportunity still comes up and, if it still makes sense with the increased interest rates, I'm going to do it. But consumer confidence, or my specific consumer confidence, I would say is trending lower in the last couple months. It's been low for a long time on it just because, like I said, everything that you look, all the numbers, all the charts, it's like we should honestly be in a recession right now. How are we still hanging on here? Really, the answer to a lot of that is AI stock. And is that a bubble? Is that not a bubble? Yeah, we're not getting into that this week. But I am probably no different than a lot of you listening right now. Do you feel very good about this economy? Do you think that we're heading on the right path? Do you think that it's smooth sailing for the rest of the year, including the election that's coming up? Look at what's going on around the world. We have issues going on with China, Taiwan, Ukraine, Russia, Iran, Israel. There is just a lot of stuff going on. I feel like that this is a powder keg ready to go at any given point. And like we've seen a lot of recessions or corrections in the past, generally the stage is set. The stage is set with a lot of bad stuff going on or mixed things going on. And there's finally one thing that kind of upsets the apple cart. There's one action, attack, crash, whatever it is that kind of starts that house of cards to fall. Luckily for us, we've been getting some bad news, some good news, some bad news, and it keeps on trucking along. And maybe we're going to get out of this. Just like when you gamble on sports, you don't care about the public money. You want to look for the sharp money. Hey, I don't care where Joe Schmo is betting about the Orioles game, but where's Vegas? What is the sharp money betting on here? And like I said before, don't worry about me. Don't worry about my opinion on this. But if the banks are nervous, I'm going to be listening. There's been a record amount of decrease in credit card quotas. In the past, if you had a $30,000 limit with Amex, they're cutting this stuff. Credit card companies are terrified. JP Morgan specifically came out, like the Mr. Morgan himself, and said that the market is saying that there is a 60% chance that we get out of this year in 2024 without a recession. So the general consensus is that there is probably a 50-50 shot that we have a recession this year. Now, what does he say? So it's kind of the opposite. So it's a double negative. People are saying that there's a 60% chance we will not have a recession. And he says, I would agree, but I think that's probably about half that. What does that mean? That means he's saying that there's a 65-70% chance that there's going to be a recession this year. If you were to say, hey, JP, what are your percentage chances that there's going to be a recession in the next 2 years? If he thinks there's 60 or 70% chance it could happen this year, then, if you're including the early part of 2025, that could go even higher. So if Wall Street is nervous, if economists are nervous, if American Express is nervous, and JP Morgan, and I'm sure JP Morgan Chase and Chase Bank and all those are nervous, do you think you should be as well? Yeah, you've heard the adage, scared money don't make money, which is true. But if you get too aggressive and you don't time this right and you kind of get overexposed on this and you get short on cash, things are not going to be very good for you. Do your research. Think about this. Don't make emotional decisions. Don't overextend yourself. Make sure your core business, make sure your core people, make sure that your core necessities are taken care of, and don't make a mistake that you're going to regret later. So I hope this was helpful for you. Please share with friends. If you have any questions, comments, or ideas for future episodes, please shoot me an email at podcast@parmelis.com. Thanks again for listening on the Aftermarket Radio Network. You can find all shows on the aftermarketradionetwork.com and on your favorite podcast listening app. So thanks again for joining me on Business by the Numbers. Stay safe out there, and I will talk to you all next week.
You've been listening to Business by the Numbers with Hunt Demarest on the Aftermarket Radio Network. Follow Hunt on your favorite podcast listening app. Let him know what you'd like him to cover. His email is in the show notes. Hunt is all for advancing the aftermarket.